Today we've got two videos. The bullishness is starting to come back out. Today we've got Keating saying we can have a correction without the markets going into a recession. We're also going to be checking out Mark Newton. He says we're close to bottoming from this recent market decline. So that's good news. They should really build off of each other, have great facts and opinions. As always, guys, if you enjoy the video, hit the like button and let's get on into it.
Major indices dropping for a third straight day. Let's bring in Keating, CEO of BNY Mellon Wealth Management. Catherine, great to have you with us.
Good morning, Melissa. Good morning, Joe.
Morning.
Great to be here.
It seems like rates of, most recently has been the reason why stocks have been having some difficulty maintaining their gains and moving higher. How do you view, a 4.3% on the 10-year, for instance, and if we stay at that level for longer?
Yeah, so if you think about the market this year, we started the year, bond market, stock market, all ready for recession. And then what happened as data came in, it was a little stronger than expected. By May, all of a sudden the market said, maybe we're not going to have a recession. And you saw the equity market just leap forward in May and June and July. Now, here we are in August, and what's the market saying? Oh my gosh, we may not have a recession. And you're actually seeing that in the bond market, obviously, with the stock market sold off 4 or 5%. Bond market sold off even more with the 10-year up 60 basis points to 430. So what does that mean? Our base case is inflation is sticky. It sticks around a bit longer. We've had a great drop from 9% to 3.2, but the 3.2 down to the 2 is a little less straightforward. Interest rates do stay high for longer, but our base case is that because of the strength of the economy, we can have a slowdown, we can have a correction in the market, and we can have a slowdown in the economy without going into recession, and that remains our base case.
Is that the way you're positioning your portfolios for a pullback in the markets?
It is how we're positioned. So I would call our positioning in our portfolios balanced. In other words, we're at our normal equity weight. We're not overweight. We're at our normal equity weight. We're overweight the U.S. for a variety of reasons. And we're also balanced when it comes to the bond market. We understand that it's been a long time since the 10-year was at 4.3%. 15 years. I greeted all of our new analysts, our college graduates that joined our company on Monday, 1,000 of them. And, when you think about the last time the 10-year was at 4.3%, they were 7 years old. It's been a long time. But nonetheless, our base case is it's good to be balanced in bonds, too. And now's actually the time to take some duration. We haven't done that in a long time because rates have been so low. But we think now's the time to take some duration because then bonds behave like bonds. You get your yield, which is a bit higher, and you also get a gain when the market goes down.
Unless the bond market continues to sell off, then it's not time. Because there are a lot of people probably buying the 10-year at 3.8 and 3.9. They have a paper loss, obviously. They can wait 10 years, they'll always get, but it's like the same problem we saw it in the banks. If you don't mark to market and you're feeling good about yourself, you're definitely not getting a competitive return. So you would say Tina's dead and there is an attractive alternative in bonds right now. You're confident enough that 4.3 is not going to be 6.2 in a year and a half.
That's right. That's what we think. And actually, when you look at industry fund flows, they're not going to bonds. They're going to money market funds. Money market funds have reached yet another all-time high. Very unusual.
So they'll be wrong. They'll be wrong. And
very unusual when the economy's growing. Very unusual.
Right.
And so again, we're pretty confident that rates are going to stay higher for longer. But our base case is that they do begin to drop.
But you didn't take money out of stocks and increase your bond allocation.
We're neutral. We're neutral.
You have which is what? And you're a wealth manager, so you've got to have what do you usually have? 40% bonds? I don't know what.
Every client is different, but you could say 60-40 or so, 60% or so in equity and equity type investment, 40% or so. It might be a little lower.
But that doesn't include
in bonds. But we're neutral on duration. We're taking duration. We're not extending it beyond a neutral bias.
And not corporates. You're talking governments.
I'm talking across the board, but most of our clients who pay taxes, they buy munis. So we're neutral duration, yes.
And what is that, 7 years?
It's 5 years.
5 to 6.
Yeah, 5 to 6.
Okay.
Within equities, though, are there pockets still that the valuations are just too high given where interest rates are? I mean, is there still further adjustment? We talked about a lot of the magnificent, quote unquote, magnificent seven down to about 12% from recent highs. Semiconductors also. I mean, we've got a key report from NVIDIA coming up, which will sort of be a test there in the AI trade. What's your view?
Yeah, so
So before she gets into it, AI is coming up in NVIDIA. We are going to see if the final nail in the coffin of AI is just going to be dead now. We saw that the hype on AI was very strong. It caused these stocks to shoot up tremendously. But as we've seen from these earnings, AI has not hit yet. And we knew it wouldn't hit. Except for if you were naive and you believed that it would hit this quick, then you're a little disappointed. But we knew AI takes time. We know big changes take time to develop into the company and actually reflect in the earnings. However, NVIDIA is the company that all of these companies are buying their chips from to create this AI and let it perform. So they might have already started to appreciate from AI, and we're going to find out in the next few days. It's going to be a game changer. It's going to be a leader. It's going to be Apple for the day. If NVIDIA disappoints, it's going to add to this sell-off dramatically because it's the last hope that AI is already started, and it's just going to go up from here. But if it goes down, it might pop a lot of that bubble and make people realize it's going to be, 6, 12, 18, 24 months before that stuff starts to hit.
The valuations remain on the high side, right? We're about 19 versus a 16 to 17 long-term average. But I always step back and remind everybody that we're investing in an economy. So where are we in the economy? And, a lot has happened in the last 3 years. But if we go back to before COVID, we actually had a very strong economy in this country. We were in the 11th year of an expansion, the longest since World War II. And then we stimulated when COVID hit, right? Interest rates down to zero, $6 trillion of stimulus. And when you look at where we are today, the consumer, 70% of the economy, is actually stronger than they were back in 2020. Their wealth has grown because the value of their homes, their equity portfolios is up. They still have cash, $500 billion of that COVID money, what hasn't been spent yet. And you look at companies, and they're stronger, too. They have cash on their balance sheets. They took advantage of those low rates to refinance. There's not going to be a lot of refinancing need for a couple of years. We think rates will be lower by then. So we actually have a very strong economy that we think will support the equity market, not without volatility, not without pullbacks. But think about this year. The market was up 20% at the end of July. We've just lost 4 or 5%. The normal correction is 14, 15% a year. We could have that this year and still have positive equity market return.
That's what I was telling you guys yesterday. If you saw yesterday's video, guys, we're up so much that no matter what this pullback is, it's a buying opportunity. This is not a negative. This is not the end of the bull run. And matter of fact, Mark Newton's about to tell us why this might be the bottom and the start to the next bull run. If you guys are enjoying the video so far, hit the like button and let's jump into Mark Newton.
Yesterday, the Dow closed below its 50-day moving average for the first time since the beginning of June. At the same time, some key market drivers have been having a rough go of it. Apple's down more than 11%, the worst performer in the Dow. Tesla is...
I've got some quick numbers right here. He might go through them. We've got Apple down 12.5%, Microsoft down 13.5%, Amazon down 7.5%, Tesla down 28.5%, Meta down 14.5%, and this is all in the last month, guys. What do I think? I think it's a great buying opportunity in my opinion. It's not financial advice, but hey, I'm putting my money to work.
Is down close to 20%. Join us now to talk about key levels he's watching. Mark Newton, Fundstrat Global Head of Technical Strategy. In the past, Mark, when you see the real horses of an advance pull back a little, it's not surprising, but it can presage some further problems. What do you think with the leaders faltering right now? What's it say about overall the technicals for the market?
Thanks, Joe, and hi, Melissa. So, we have seen a little bit of damage in, the near-term performance of the leaders, so to speak, but you really haven't seen it in stocks like NVIDIA just yet. As Melissa mentioned, Apple and NVIDIA are all both down, I think, about 12% from their peaks, but really no substantial longer-term damage that would warrant that investors would want to avoid these stocks. Most of these have had substantial runs off the lows. Look, the market has changed in recent days, and it had been very orderly. We've started to see a little bit of a pickup in the decline. However, there are a lot of reasons to suspect that we are close to bottoming, not that this is a decline that's just going to continue over the next couple months.
Tell us. What?
So, look, in general, I would argue that Treasury yields are getting up very close to levels where they ought to peak out, and that would go really against the common narrative that Ackman and others have said. We've not technically broken out above last October's peaks, either the 30-year nor the 10-year. I think that's important. Technology as a sector has not really broken down. So in equal-weighted terms, if you look at equal-weighted tech versus equal-weighted S&P, we've had a little bit of pullback, but really in the last few weeks, it's more been discretionary financials and materials that have lost ground. Tech, to its credit, has actually held up fairly well. And I think that's important. The third is that sentiment has really started to back off in the last 2 weeks. We had pretty optimistic levels in late July. That has certainly retreated. And as Mike Santoli commented on earlier, all these sentiment gauges and really the oversold conditions are very close to materializing, getting close to levels that we saw back in March. So, I think we have a week or two. I think Jackson Hole could be a pivotal event with regards to yields. If Powell comes out hawkish and we see yields really start to turn down sharply, that should be a big positive for equities.
Mike mentioned that, NVIDIA is down a little, but you really look at the advance and take some of the other ones you were talking about. I mean, Apple, $2.7 trillion. NVIDIA is now $1 trillion. Do you worry about the law of large numbers? I mean, is NVIDIA going to be $2 trillion?
Yeah, look, I think NVIDIA likely gets up to near 500. It's tough for me to say that my skill set isn't about saying these stocks are going to double after the move that they've had. I think that trends remain very much in place. NVIDIA has certainly shocked a lot of people that wildly underestimated how it would do. I don't know that technically, I think you have to say the same thing. It's really, you have to use a different playbook with stocks like NVIDIA. We have gotten overbought. That certainly doesn't mean you sell it here. I mean, it hasn't broken up trends. And, my own views, I own NVIDIA. I think the stock goes higher. I think it's in much better shape than a lot of those other, horses that we've been talking about.
He makes an interesting point. You do almost have to use a different playbook with these Magnificent Seven. If you look at the run at face value, it's pretty easy to say that they're overbought. But if you take into consideration what we've sold off, how we've come back, how much earnings have grown over the time of the last 2.5 years, how much more efficient the businesses have been forced to get over the years. And then you take a look at the PE ratios on most of these companies. Guys, they're still trading in line. A little bit rich, but with this pullback, they're getting back to in line and in good values, believe it or not. So it's not all technicals, especially when you've had 2.5 years of a recession. You do have to use a different playbook and look into the future, because these companies aren't going anywhere anytime soon.
I saw something earlier. When the NASDAQ is at the same levels that it's gone nowhere as an average for like 3 years, I think, almost, right, Mark?
Well, look, we've had a pretty substantial move off the lows, and a lot of that has been carried by the Magnificent Seven. But the broader market really started to widen out. We saw a lot of really good participation since May. I think that's really been important. Investors have recognized that. We did see a lot of short covering in July. So institutional investors have been slowly trying to participate. But, this has been a shot across the bow, I think, in the last couple of weeks. And people have gotten, a little bit caught off guard. So, my own thinking is that, FANG and or NASDAQ is going to continue to show outperformance, because I think that yields are closer to peaking. I think that rolls over sometime starting probably in the next few weeks between now and end of year. So if yields really start to roll over, that's going to be very, very good for technology.
In your view, will we see new highs in the NASDAQ and the S&P in the next 6 to 12 months?
Yeah, I do think we're still within what I would call probably a 2-year bull market that started last October, 2 to 3 years. And so this minor pullback, it's been 3 weeks. It certainly caught some people off guard. But look, it hasn't really shown much deterioration in the larger technical structure with regards to, just broader trends. We've seen just a little bit of a pullback. I think S&P gets back to 4,600. My own target for the year is 4,700. And, I think that the near term 4,300 to 4,330 likely can provide some support to this recent pullback. I don't really see the reason why we need to go down to, as many people are saying, 3,200 or so. I think that's really not in the cards for this year or next.
And if you're wrong on interest rates, would that change your view on all these other things?
Well, look, if 10-year gets up above 450, you know, certainly that's going to spook the market. We saw signs of that when it got up above 4%. But I look at things like sentiment, Elliott wave, even DeMark indicators. I mean, some of these are starting to show that the yields are getting close to peaking. So, yeah, we need to see rates roll over, and the economic data has been resilient, and so is the housing data. That's caused rates to really scream up. But you know, we're getting towards a juncture where the upside is going to be limited, I think, for yields in the near term. It's going to be worth buying treasuries and thinking that the yield pullback.
So there's a lot of great points made for the bond market and for the stock market. I think that as long as the 30-year does not keep on this tear and we start to peak out, I'm in the camp that we are near bottoming. These stocks have fallen off of a cliff in a relatively short amount of time. Compared to how consistent we went up in a straight line, we've seen time and time again over the last several months, these big money managers, they come on and they've looked at history and they see all the years that start this bullish, they end even more bullish. So we have to keep that in mind, guys. I think it's starting to look up. We've got a little bit of a discount on some of the bigger names. We've got some great entry prices to start a position or add to. And as always, I hope you guys enjoyed the video, and I'll catch you in the next one. Peace.